Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at the MACD indicator and 3 different ways that traders use this in their trading. In today's lesson we're going to look at indicators which are known as oscillators, starting with one of the most popular oscillators, the RSI. So let's get started.
Okay, so an oscillator is a technical indicator which fluctuates above and below a center line and normally has an upper and lower band which indicate overbought and oversold conditions in the market. An exception to this upper and lower band component would be the MACD, which we learned about yesterday, which is an oscillator as well, but is not encompassed by an upper and lower band. One of the most popular, what's known as banded oscillators, is what's known as the RSI, which is what we're going to start our discussion on oscillators with today. The RSI is best described as an indicator which represents the momentum in a particular financial instrument, as well as when it's reaching extreme levels to the upside, which is referred to as overbought conditions, or extreme levels to the downside, which is referred to as oversold conditions. The indicator accomplishes this through a formula which compares the size of recent gains for a financial instrument to the size of its recent losses. The results are then plotted as a line which fluctuates between 0 and 100, and bands are then placed at 70, which is considered an extreme level to the upside, and 30, which is considered an extreme level to the downside. So let's take a look. This is what an oscillator looks like. You can see the price chart there, and you can see the RSI plotted to the bottom, and you can see the center line there at level 50. And the upper band at 70 and the lower band at 30. Okay, so that's what an RSI looks like when it's plotted on a chart, and you can see how it fluctuates above and below those lines, and we're going to look at what that means next. Okay, so there's several different ways that traders use the RSI in their trading. The first is to identify overbought and oversold conditions in the market. As we just talked about, when the RSI is below the 30 line, this is considered an oversold level, and therefore traders are going to look to trade a reversal of the trend there, because it's the boat is tipped too far to one side, so to speak. So you can see here the RSI goes below 30, the market bottoms there and then turns upward, and then the market continues upward, goes into overbought territory on the RSI, and then you can see it turns downward after that. Okay. The second way that traders use the RSI in their trading is what's known as RSI divergence, and this is similar to what we learned about with the MACD divergence. If the indicator, the RSI, is trading in the opposite direction or trending in the opposite direction as the price action of the financial instrument that you're analyzing, this tells you that momentum is waning, and therefore that particular financial instrument may be due for a reversal. So you can see here the market is making a new high, but the RSI is not, and that is a divergence there, showing that the market may be running out of steam, and in that case it was, and it sold off pretty dramatically right after that. Okay, the third way that traders use this in their trading is what's known as the centerline crossover, and this is a less reliable signal than the first two. So you're definitely going to want to use this one in conjunction with some of the other things that we've learned about, or some of the things that we're going to learn about in future lessons. But basically, what this is when the RSI crosses above the 50 line, that's considered a bullish sign, and because the market is making more highs and making more gains than it is losses. And when it crosses below that center 50 line, that's considered a bearish sign, because the market is making more losses than gains. And so here's an example of how you could use that, and how it would have actually worked very well recently trading the euro dollar. You can see there's a head and shoulders pattern there that we learned about in one of our previous lessons, and then you can see the RSI makes a bearish crossover, confirming so to speak, that break below the neckline of the head and shoulders pattern is legitimate, and in that case you'd have called a nice big candle down. It might catch a few more in the days that come as a result of that confirmation. Okay, so that's our lesson for today. You should now have a good understanding of the RSI and how traders use this in their trading. In tomorrow's lesson, we're going to look at another oscillator, which is known as the stochastic oscillator. So we hope to see you in that lesson. As always, if you have any questions, please feel free to leave them in the comment section below. And have a great day.